Hello, guys. This is a lecture for exercises for chapter 13. We'll start with 13.2. 13.2 is talking about dropping or retaining a segment, which is adding or dropping a line. The example, talking about a company and had three kinds of bicycles. The Regal Cycle Company manufactures three types of bicycles: a dirt bike, a mountain bike, and a racing bike. And it is clear from these three columns. The first column is talking about the total, so data on sales and expenses for the past quarter follow. We do have four columns. The first column is the total, which refers to the whole company, including the three types of bicycles. The next column talking about dirt bikes, next mountain bikes, next racing bikes. Look at these numbers. The sales for the three bikes and the total, variable manufacturing and selling expenses, fixed contribution margin for the three bikes and for the total, fixed expenses. We do have four kinds or types of fixed expenses: total fixed expenses and the net operating income or loss. Now, if we look at the net operating income or loss for the three bikes, we can see that the racing bikes line has a loss for 9,000. So management, I'm reading in the question now, management is concerned about the continued losses shown by the racing bikes and wants a recommendation as to whether or not the line should be discontinued or stopped. The special equipment used to produce racing bikes has no resale value and does not wear out. Now, if I look again for the net operating income, we do have a profit for the dirt bike for 17,000. We do have a profit for the mountain bikes for 25,000, and we have a loss for the racing bikes for 9,000. Now, the management is thinking about to stop or to discontinue the racing bikes because we do have a loss. The question is, what is the advantage or disadvantage per quarter if we discontinue the racing bikes? If we stop the racing bikes, what will be the advantage or disadvantage from this? Now, for the managerial accounting, we cannot think about only the number of the net operating income. Why? Because we do have some expenses, as we explained in the chapter, irrelevant for the decision. The means or the meaning of irrelevant, which means this cost is paid regardless the decision. If we discontinue or we stop the bike or we keep it, we have or we pay the irrelevant costs regardless for the two choices. In this case, we will exclude the irrelevant costs. Now, for number one, what will be the financial advantage or disadvantage of discontinuing the racing bike? Now we have to think about the case. If we close the racing bike, what will be the effect for the net income for the company? We do have two approaches for the solution. The first one is called the contribution margin approach. The second one is called the income statement approach. Maybe the easier to be to prepare the two statements or two income statements. The first one with the bike, the second one without the bike, okay, or the racing bike. And we can see the difference in the total profit for the company. This is a case. The second case is called the racing bikes. The contribution margin approach. Contribution margin approach is talking about directly what will we lose if we close the bike. Let's start with the contribution margin approach. Contribution margin approach. So what is the financial advantage or disadvantage if we stop the racing bike? Now, if we stop the racing bike, we will lose the whole sales from that line, and we will not pay the variable expenses from this bike. So we will not have the 60,000 as sales from this bike, racing bike, and also we will not pay the variable expenses because it depends on the sales or production. If we produce and sell the racing bike, we will pay the variable expenses. If we stop it, then we will not pay the 33. In other ways, we will lose the whole contribution margin. We will lose the whole contribution margin. So if you like, we will start with this exercise is 13.2, and I will start with the contribution margin approach in finding the advantage or disadvantage. So the lost contribution margin, we will lose the whole 27,000, which is the contribution margin of the line, right? Now, comparison with the fixed costs that you can save. So the other title will be fixed costs that can be avoided. That can be avoided if we stop the line, right? If we stop the line. Go back to the question. We do have advertising, traceable, depreciation of special equipment, salaries of product line managers, and allocated common fixed expenses. According to the question, management is concerned about stopping, right? The special equipment used to produce the racing bikes has no resale value and does not wear out. Now, we have to decide whether we can avoid each of these fixed expenses or not. The advertising, because of the word traceable, we can understand that if we stop the racing bike, we can avoid the 6,000 because of the word traceable. If we have a word of allocated, most likely we cannot avoid that. So the advertising can be avoided, or we can stop paying the 6,000 related to the racing bikes. So in the answer, we can say the fixed cost can be avoided. One of them is the what? The advertising. Advertising, because of the word traceable, we can see, or we can say that it is can be avoided. Advertising can be avoided by 6,000, and this number should be in positive, which means that we can avoid it. Okay. Now, the other one, the depreciation of special equipment, because of the word here, the special after the table used to produce racing bikes has no resale value and does not wear out, which means we will pay the depreciation, which is related to the machine, regardless if we keep or stop the line. In this case, we cannot avoid the 8,000 related to the racing bikes of depreciation, which means in all cases, the company will pay 23,000 in total for the depreciation of a special equipment because we cannot avoid it. If we do have a resale value for this machine, this means that we can avoid the 8,000. In this case, the 8,000 will be avoidable and it will be relevant for our decision. But for the word, the special equipment used to produce the racing bikes has no resale value and does not wear out, which means we cannot avoid it. This means it is irrelevant in our decision. So I will not include it in my calculations here, okay? The salaries of product line managers can be avoided because it depends on the production and selling. We do have a manager or a line manager for the dirt bike, and we're paying 12,000 for that manager, 13 for the mountain bikes, and 10,000 for the racing bike. if we stop the racing bike or bike line, we can avoid the 10,000 salaries of product line manager. So this will be included in our decision, which means it is relevant for our decision. So salary of product line manager can be avoided for 10,000. So the 10,000 is relevant, as we say, in our decision. The word allocated common fixed expenses, and the note here, allocated on the basis of the sales dollars. Most likely the word allocation means it is irrelevant for our decision, which means we have to pay these expenses whether we stop the line or we keep the line. So we cannot avoid or save the 12,000 related to the racing bike. So the only numbers that we can avoid it is the 6,000 and the 10,000 related to the racing bike. Comparison between the total of these two numbers, which is 16,000 in a positive number and the 27,000 in a negative number, we can find that the difference is a negative for 11,000. Negative number means a disadvantage, financial disadvantage. Disadvantage for 11,000. Disadvantage means we will lose more if we stop the line. Disadvantage again means if we stop that line, we will lose more by 11,000. So we will lose more than 32,000 if we lose the racing bike. So this is the final answer for number 1. For number A or 1, we will lose, or we have a disadvantage for 11,000. Number 2, then we can say that number 2, should we stop the line? The answer is no. Number 2, go back to the question. Number 2, should the production and sale of racing bike be discontinued? The answer is no. The production and the sales of racing bike should not be discontinued. Why? Because referring to number 1, we have a disadvantage. Disadvantage means that we have to keep it. We have to keep the line. Number 2, no. Racing bikes should not be discontinued. Racing bikes, lines or line should not be discontinued. Why? Because we do have a disadvantage from number 1. This is the answer for question 13.2. An alternative, as I say, alternative solution will be the comparison between keeping the racing bike or without the racing bike. So we have to remove the third column here and see what is the total numbers here. So the 30,000 will be 24,000 because we can avoid the 6,000. If you like, we can also add the numbers here. The sales will be 300 which is the not 300, 240, because we exclude the racing bikes. So I'm talking about the dirt bikes, 90,000, and the mountain bikes for 150,000. So the total will be only 240,000. The variable expenses, if we exclude the racing bikes for 33, then the number will be 120 minus 33. 120 minus 33. 120 minus 33. This will be 87. Variable expenses. Variable costs will be 87,000. So the contribution margin will be what? The difference between these two numbers, which is what? Minus 240, 207,000, the contribution margin without the racing bikes. What about the fixed expenses? Fixed costs. Fixed costs, one by one. One by one, look. The advertising. Advertising can be what? Referring to the first two only. Because we can avoid the 6,000. So the 30,000 will be 24,000, right? The depreciation will be the total because we cannot avoid all the depreciation. So it will be, or still 23,000, okay? The salaries of the managers can be avoided for the racing bikes. So instead of 35, it will become 25,000. The last one will be the allocated manufacturing overhead. And this number is irrelevant. So I have to pay the all 60,000 fixed cost. So the total here will be 24 plus 23 plus 25 plus 60. So 132,000 is the total of 132,000 is the total for fixed costs. This will be compared to the contribution margin plus minus 207. This will be 75. The net operating income will be the difference between the contribution margin and the the 240 minus the 87 will be the 240 minus 87, 150. Oh, we have a number here wrong. The contribution margin, which is the difference between 240 and 87. 240 and 87, this equals to 153. I have a mistake here. 153 minus 132, this equals to 21. $153, 240 is the sales minus variable expenses will become 120 minus 33, 87. So 240 minus 87, this equals to 153. 153 minus 132, this equals to 21,000. Yes, 21,000. Look, $21,000. Okay, so we will recognize this situation. The title of this situations is dropping the racing bike. Okay, racing bike. Dropping the racing bike will recognize a profit of 21,000, but keeping the racing bike, which is the income statement given in the question. This will be 300,000. This will be 120,000. And the contribution margin will be 180,000. I'm copying the numbers given in the question. This will be 30,000. This will be 23,000. And this, the salaries is 35,000. The allocated manufacturing overhead is 60,000. So the total of the fixed expenses will be 148,000. If you like this method, will be fine. Now, the net income will be 32,000. Look at the net income for the two situations. If we drop the racing bike, and just to remind you about the approach. So this is called income statement approach. If we have to decide according to the income statement approach, we need to prepare the two income statements without the racing bike or with the racing bike. Without the racing bike, we will recognize a net income of 21,000. Keeping the racing bike, we will recognize 32,000 as a net income. So the difference in net income between the two situations, what can you see here is, if we drop the line, we will recognize less net operating income. What is the difference between the two net incomes? If we keep or drop the line, it will be 11,000. So if we keep the racing bike, we will have a more net income than if we drop the bike by 11,000. In a negative number means we have to keep the racing bike. If you understand the income statement approach, will be fine, but I can see that the contribution margin approach is a little bit easier. The contribution margin is only talking about the relevant information only, which means only include the relevant information. Again, just a comparison between the two approaches. Look, the contribution margin approach only talking about the relevant information. We will lose the whole contribution margin, which is 27,000, but we will save only the advertising of 6,000, the salaries of the manager for 10,000. So comparison between the 16 and the 27, we will have a disadvantage of 11,000. Compare this result with the two income statements here. The two income statements will give you keeping or dropping. So you have to prepare the income statement of keeping, which is given in the question, and we will have a 32,000 income if we keep it. If we stop it or drop it, we will have 21 income statement or net income for the whole company. So we will lose additional 11,000 if we drop the line, and the decision is keep the line because we will have more income. The word disadvantage means we will lose more, or we will have to decrease our net income if we drop the line. This was the answer of number three for exercise 13.2. Okay, 13.2, and this is number 3. 3, which is prepare a properly formatted, segmented income statement that would be more useful to management in assessing the long-run profitability of the various product lines, which means if the managers cannot understand the contribution margin approach, which is here in number 1, then you have to prepare number 3, which is the two income statements for the two options, if we drop the line or keep the line. Comparison between these two numbers, the 32 and the 21, we can see if we keep the line, we will have more income than if we drop the line. That's all for exercise 13.2. Let's solve 13.3. Make or buy decisions. Make or buy. Make or buy we are talking about make internally or buy it from outside. Okay. Troy Engines manufactures a variety of engines for use in heavy equipment. The company has always produced all the necessary parts of its engines, including all of the carburetors. An outside supplier has offered to sell one type of carburetor to Troy Engines for a cost of $35 per unit. So we have an offer to buy it from outside for $35 only, instead, or comparing to the manufacturing, which costs the company $42, the total cost of manufacturing. Troy Engines has gathered the following information related to its own costs of producing the carburetor internally. The making or producing internally will cost the company $42 in total. Look, if we produce the carburetor, we will pay the direct materials costs of $14 per one unit and a total of to 10,000, depending on we need 15,000 units from carburetors. So the cost of the materials will be 14 per one unit, multiplied by 15,000, and the cost will be total 210,000. The direct labor cost $10 per one unit, and the total cost will be $150,000. Variable manufacturing overhead will be $3, and the total will be $45,000. Fixed manufacturing overhead, traceable, $6 per one unit and $90,000 per year or for the whole units. But we do have a note here. It is written underneath. One third of the $6 represent the supervisory salaries, which means avoidable or can be traceable and avoidable. And in this case, it will be relevant for our decision. But the two-third, which is $4, one-third, 1 out of 3 multiplied by 6 is equal to $2. This is supervisory salaries. 2 out of 3 multiplied by 6, this will be $4. This represents depreciation of a special equipment, and again, no resale value, which means the $4, which is the two-thirds of the $6, is irrelevant. This means it is not relevant for our decision, which means we have to pay the $4, either we buy or make the carburetors. The fixed manufacturing overhead allocated, the word allocated again, which means it is irrelevant. This means again that we have to pay the $9, either we produce or make buy it from outside. The allocated fixed manufacturing overhead is paid, either we produce or buy it from outside. And the total will be $135,000. The total cost will be $42 per unit and $630 for the whole 15,000 units. Now, assume that the company has no alternative use for the facilities that are now being used to produce the carburetors. What will be the financial advantage or disadvantage of buying 15,000 carburetors from the outside supplier? Go back to the question and we think, or we have to think about two numbers mainly, the $35 of buying, cost of buying, and we will think about the 42. What are the components of the $42? $42. Okay. The cost of making is negotiable, but the cost of buying, we can say we will save, or we have to pay what? We have to pay what? Look, let's have Excel sheet here. The Excel sheet can have mainly two titles, making or buying. We'll start with buying, okay? So I will type here buy the 15,000 units, and the cost will be what? The cost will be $35,000, okay? So the cost here, the cost of buying will be what? The 15,000 units multiplied by $35, right? So this will be a $, $525,000. We have to pay $525,000 if we buy it from outside, okay? Now, the first column, we're referring to the making. So this column includes making the 15,000 units. And let's see what will be the cost of making. The cost of making here, if we make the carburetors, we have to pay the direct materials. In this case, the direct materials is relevant. If we buy it, we can avoid paying these materials. So the cost will be $14 per 1 unit, and the total cost will be $210,000, $210,000. Okay. What else? The labor, direct labor. Direct labor is also avoidable. Avoidable means what? If we buy it from outside, we will not pay this cost, which means it is also relevant or avoidable. And the cost will be $10 per 1 unit. In total, I'm paying $15,000 or $150,000. Okay. Variable manufacturing overhead. Variable manufacturing overhead, which is the $3. $3, go back to the question, is a variable manufacturing overhead, which means I can avoid it if I buy it from outside. The total will be $45,000. $3 multiplied by 15,000 units. This will equals $45,000. Okay. The next will be the fixed manufacturing overhead. This is negotiable. What does that mean? The fixed manufacturing overhead. The fixed manufacturing overhead. As we say, the supervisor salaries, which is the 1/3 of the $6, can be avoidable. Can be avoided if the carburetors are purchased from outside. The remaining, which is the 2/3 multiplied by 6, which is $4, is a sunk cost. What does that mean? The special equipment and the related depreciation is a sunk cost, which means we have to exclude it from our decision. Why? Because it is irrelevant, not relevant to our decision. So the only amount that we can avoid if we buying from outside, the $2, which is multiply by 15,000 units, this equals to $30,000. $30,000. What about the $9? All the $9 is allocated, which means is also irrelevant, and we have to exclude it from our decision. So we have a total of what? The total cost for making the 210 plus 150 plus 45 plus 30, this equals to $435,000. Comparison to what? Comparison to $525,000. $525,000. This is the comparison. Why? Because this will be the relevant information. Relevant information. These can be avoided. The others cannot be avoided, so we will exclude it from our decision. So we do have a disadvantage. The final answer will be disadvantage. Why? Because the buying is more expensive than the making. So we do have a disadvantage of buying the carburetors from outside by what? $90,000, which is the difference between the cost of make or cost of buy. In other ways, if you like, go back to the question. We do have the cost of making of $630,000 total, and cost of buying, which is 525. But the 525 is compared not to as it is. We have to add the cost of the 135,000, the whole number, and the 60,000, which is the $4 multiplied by 15,000 units. This equals to 60,000. These are unavoidable. So if you like, in other ways, we can say what? The 630 is compared to what? The 525 plus the 135 plus the 60. This will equals to $720,000 minus $630,000. This equals to 90. Again, if you don't like this way, you can see, go back to the question. The total cost of the making is 630. Okay, but the total cost of buying is not 525 only. It is not 35 multiplied by 15,000 units, which equals to $525,000. No, you can say that the fixed manufacturing overhead allocated is paid, either we buy or make. So we have to add the 135 to the 525. And also go back to the fixed manufacturing overhead traceable. We do have $4 related to the depreciation, which is also paid whether we buy or make. So we have to add also the 60,000 to the 525. Now we can say the cost of buying will not be only 525,000 plus 135,000 plus the 60,000. So the total cost of buying is equals to 720,000. 720,000 will be compared to the 630,000, and the answer would be 90,000, which is the same answer that we extract from our solution here. So the buying has a disadvantage of 90,000. In this case, we have to recommend making, not buying. So number 2, the question of 2, should the outside suppliers offer be accepted? The answer is no. No. The offer should be rejected. Why? Because making is cheaper, or should continue to produce the carburetors internally. Okay, again, the answer referring to the question, should the outside supplier offer be accepted? The answer is no. Why? Because the cost of buying is bigger than the cost of making. So the recommendation, we will recommend the company to continue to make the carburetors internally. Okay. Number 3, suppose that if carburetors were purchased, Troy engines could use the freed capacity to launch a new product. The segment margin of the new product would be $150,000 per year. Given this new assumption, what would be the financial advantage or disadvantage of buying the 15,000 carburetors from the outside supplier? Compare this, number 3, with number 1. Number 1, assuming the company has no alternative use for the facility. So we cannot use the space of production for any other alternative. But number 3, if we buy it from outside, we can earn $150,000 per year. So this will be added as an opportunity cost. In other words, if we make it, we will lose this potential margin. So the 150,000 should be added to the cost of making in number 3. So the decision can be different given the new assumption in number 4 and requirement 3. Should the outside suppliers be accepted or not? So I will repeat the solution in number 3. And I will say what? Making, I'm working in number 3 now. Number 3 says that if we have an opportunity cost, what will be the difference in the solution? Okay, what will be the difference in the solution? Look, the making solution would be what? If we have this total, okay, if we have this total for the costs of making 435, we will add the opportunity costs. Opportunity cost, which is the margin for gun on a potential new product line, which means if we make, we will lose the 150,000 given in the question as an amount that we can save or have if we use the space for the production. So this will be added to the cost of making. So the total cost in this case will be 585 for the making. Again, guys, for the opportunity cost, regarding to the question, they said, suppose that the carburetors, if we purchase it, the company could use the capacity or the freed capacity to launch a new product. If we have the new product, the segment margin of the new product will be 150,000. If we buy it from outside, the space can be used to another product. If we use it to another product, we can earn 150,000 per year. So we give up this cost because we choose to produce the carburetors. So this will be added as a cost of making. So the total cost of making in this case would be $585,000, comparison to $525,000 for buying. So we do have what here? We do have an advantage. The final answer will be advantage of what? Of buying. Why? Because we have a cost of buying less than cost of making in this case, and the number or the answer will be 60,000, a positive number, which means the cost of buying is less than the cost of making, referring to number 3 because of the opportunity cost. Okay, so number 4, we will say, given the new assumption, the company should accept. Again, the question, given the new assumption requirements, should the outside supplier's offer be accepted? The answer is yes. We have company should accept the offer. Why? Because the cost of buying in this case is cheaper or less than cost of making it, given the new assumption. This was the question number 13.3. Okay, 13.4. A special order decision. Imperial Jewels manufactures and sells a gold bracelet for $189.95. The company's accounting system says that the unit product cost for this bracelet is $149, as shown below. We do have materials for $84, labor for $45, manufacturing overhead for $20, unit cost is $149. The members of a wedding party have approached Imperial Jewelers about buying. This is a special order. We received a special order of 20 units of these gold bracelets for a discounted price of $169.95. So the special price will be $169.95. The members of the wedding party would like special filigree applied to the bracelets that would increase the direct materials cost per bracelet by $2. If we accept this special offer, the direct material will become 86, not 84. This is the first thing. Imperial Jewelers would also have to buy a special tool for $250. This is a fixed cost to apply the filigree to the bracelets. The special tool would not have or have no other use once the special order is completed. So this will be added to the special order. To analyze this special order opportunity, Imperial Jewels has determined that the most of its manufacturing overhead is fixed and unaffected by variations in how much jewelry is produced in any given period. However, $4 of overhead is variable with respect to the number of bracelets produced. So the $4 here will be relevant, and we can include it in our decision. The company also believes that accepting this order would have no effect of its ability to produce and sell jewelry to other customers, which means the fixed costs will not be affected, most likely, other than the $250. Furthermore, the company could fulfill the wedding party's order using its existing manufacturing capacity, which means no change for the fixed costs. What is the financial advantage or disadvantage of accepting the special order from the wedding party? Should the company accept the special order or not? Good. So we need to decide if we have an advantage or disadvantage of this special order. Now, the special order decision, talking about what? Talking about incremental expenses. So 13.4, exercise 13.4. if we have Excel sheet, okay, I will say, remember that we have to use something called incremental costs or revenues. So we will calculate the incremental revenues first. If we accept the offer, this will have the price of the special order will be 169.95, right? If we accept the offer, which is 20 units, we will earn what? We will earn, if you like, this is a special offer for 20 units or for 20 brackets. If we accept the offer, we will earn $3,399, which is the 169.95 multiplied by 20. Okay. The incremental variable costs. Incremental variable cost includes what? Direct materials. In this case, I have to say 86 multiplied by 20. 86 multiplied by 20, 1720. Materials, $86 multiplied by 20, this equals to $1,072. $1,072. Direct labor for $45, and this equals to $900, right? $900. Variable manufacturing overhead. Variable manufacturing overhead. This will be only for the $4 here is the relevant cost for the variable manufacturing overhead. The $4 is only the relevant cost of the manufacturing overhead. So we will pay $80, $4 multiplied by 20 units. We will pay $80 for the special order. Okay. So we do have total variable costs of what? 2,700. Okay, but we have additional machine, so incremental fixed costs. Incremental fixed costs, we have to pay the machine or to buy a machine for an amount of 250, a special tool. So the total costs or incremental costs will be what? The variable costs and the fixed costs. This will equals to what? 2,950. 2,950. So what is the difference between the incremental revenues and incremental costs? What is the total incremental revenues and what is the total incremental cost? If you like, we can put it here in a new column, much better, just to analyze the numbers. The incremental revenues will be 3,399, and the total incremental cost will be 2,950. So the advantage, why it is an advantage? Because the total incremental revenues exceed the total incremental cost by $449. $449. which means number 2, should we accept the offer? Yes. Why? Because we do have a positive number, which is an advantage of special accepting the special order. So number 2, the answer will be what? Should the company accept the special order? Yes, since we have an advantage. Okay, we have an advantage. Okay, that's all for this special order. The last exercise, which is also important, I will go for 13.7. 13.7 is talking about sell or process further. Dorsey Company manufactures 3 products from a common input in a joint processing operation. Joint processing costs up to the split off point total $350,000 per quarter. For financial reporting purposes, the company allocates those costs to the joint products on the basis of their relative sales volume at the split off point. Unit selling price and the total output at the split off point are as follows. We do have product A, B, C. Selling prices for these products 16,825 respectively. Quarterly output 15,000 pounds, 20,000 pounds, and 4,000 gallons respectively. Each product can be processed further. Our question is about, are we going to process further or sell it at the split off? Each product can be processed further after the split off point. Additional processing requires no special facilities. The additional processing costs per quarter and unit selling prices after further processing are given below. Additional processing costs. If we go further to produce these products, we will pay 63,000 for product A, 80,000 for product B, 36,000 for product C. And if we process further, we can sell A for $20, B for $13, C for $32. What is the financial advantage or disadvantage of further processing each of these 3 products beyond the split off point? Based on your analysis in the requirement 1, which product or products should be sold at the split off point and which products should be processed further? Now, the key for this question, are you going to sell the products on the split off point or to further process? Which means, what is the incremental? Here we have to think about the incremental benefit comes from processing further, right? So if we are going to process further, this means that the product has a benefit if we process further. The solution for number 1. Again, the idea about the question, if we have an advantage of further processing, which means the profit from this product can be bigger if we process further. Otherwise, we have to sell it in the split off point. So the key for the answer is the comparison between, again, the incremental revenues and the incremental costs. Incremental revenues and incremental costs. So we have to calculate the incremental revenues from each product and compare it to the incremental costs for each product. For product A, B, and C, what is the incremental revenues means? Incremental revenues, if we process further A, we will sell it for 20. But if we sell it in the split off, we will sell it for 16. So we do have an incremental revenue per 1 pound or gallon. Pound for A is $4. Multiply by how many units do we have to sell from product A? 15,000. So let's start writing the answer. Selling price after process further or further processing. Selling price after further processing. For number A or for product A, we do have what? We do have to sell it of 20, right? 13 for B, 32 for C, minus the selling price at the split off. Selling price at the split off point. If we sell A at the split off, we can sell it for $16. Okay, this 8 and this 25. Now the difference between these two is called incremental additional revenue per 1 unit for each product. So we do have $4 here, $5 here, $7 for C, right? Multiply by total quantity for each product. Multiply by total quantity for each product. So we do have 15,000 units in A, 20,000 units from B, 4,000 units given from C. So the total incremental revenues, if we go further, if we process further, we can earn $60,000 from A, $100,000 from C, 28,000 from C. 60,000 from A, 100,000 from B, and 28,000 from C. Now, this will be compared to the what? To the total incremental costs. What does that mean? If we process further, if we make additional processing for the products, we have to pay also additional costs. Given in the question, we have to pay $63,000 if we process A further. We have to pay $80,000 if we process B further. We have to pay $36,000 if we process further with C. Now the comparison is clear. If we go further to process A or product A, we will have to pay more or to have a disadvantage here. The answer is 3,000 as a disadvantage. Why? Because the incremental costs are bigger than the incremental revenues. So we have to call it a disadvantage. So what is the decision here? A should be sold at the split off and should not be furthered or processed further. What about B? We do have a positive number for 20,000. So B should be processed further, which means I will not sell it at the split off. I will sell it after further processing. Similarly, for the product C, we do have a disadvantage of $8,000. So product C should be sold at the split off. So the answer here is financial advantage, or between brackets, disadvantage of of further processing. As you can see, we do have a disadvantage for A and C. We do have an advantage of B. So question number B2, based on your analysis requirement, which product should be sold at the split off and which product or products should be processed further? So the answer should be what? Product number 2, products A and C should be sold at the split off point, but product B should be what? Should be processed further. Why? Because we have an advantage of B, but we do have an advantage of C. Look at the last cell for the table. We do have an advantage for B, which is a positive number, but disadvantage of A and C. So product A and C should be sold at the split off. So we have to sell A for 16 at the split off, C for 25 at the split off, but for B, we have to sell it after further processing for $13. That's all. Thank you very much. Thank you.